I'm going to talk just macro first and then a couple of key picks and then briefly some one-liners on some topical stocks. So the macro view, the chart you're seeing here basically shows you that right now 95% of the NBN is done. So we are through that. If you talk to Telstra, they say we have seen, or by June of this year, we will have seen 90% of the earnings hit from the NBN. So we are pretty much finally through the NBN rollout and the impact it's had on earnings. A chart on the bottom there shows you prices. What you've seen is years of pretty significant price declines, but they have stabilised in NBN, the retail prices, over the last 12 months. If we then look at mobile, obviously fixed and mobile are the two biggest drivers of earnings broadly in the telco sector, hence these slides. What you can see on the mobile side is a pretty similar story, really. You've seen some fairly significant price declines, but they have actually stabilised in the last 12 months. As I said, mobile as well as fixed line are the two biggest earnings drivers in the sector. So just looking at the macro views there, we've seen that NBN rollout basically finish. We've seen mobile pricing broadly stabilise. Some figures there in the post-paid side of things, the price decline in the last 12 months per gig's been about 35%. The few years before that, it was closer to 50%. So that's I guess, a broadly healthy rate of price decline given the commoditisation and technology advances lower the cost of moving data. So we're seeing it stabilise in both fixed and mobile, which is very healthy. I guess the problem, though, is we still haven't seen any market share change, both in NBN and mobile. Telstra's very broadly held their market share. I guess the one interesting thing on the fixed side of things is that we've seen the others, the small startup companies, actually start to take some market share and grow above that 5%. So not going to run through this other than to say that it does still cost at least 5 times more to bring a gig of data down over the mobile network versus the fixed line network on average. So we need to see that 5G rollout come through if people want to start switching across economically. If you're hunting for a mobile plan, Vodafone's got the cheapest one. NBN plan, Superloop's actually got the cheapest one. So in summary, it's very much like Groundhog Day. I've been standing up here for a while talking about those price declines and stabilisation. We have seen nothing particularly change in the last 6 months and no market share change, as I mentioned. I guess what is interesting, though, you've seen Telstra and Optus talk a little bit more about being economically rational and having poor returns in the mobile network. The million-dollar question is TPG. They haven't said anything, and they have a lot of unused spectrum. So they are still, I think, fairly aggressively chasing the market in mobile. So if we jump into companies specifically, this week we've got Telstra reporting on the 11th. The chart in the top, you can see the orange line is their free cash flow per share, and the other two lines are EPS and DPS. The real question is, do they cut their dividend in this half? I'm looking at consensus. I'm the only person that seems to have a dividend decline. I've got it dropping 1 cent based on them sticking to their EPS policy. In fairness, they've never stuck to their dividend and EPS policy since they brought it out, which is a few years ago. And as that chart tells you, the free cash flow is higher. So there's a reasonable chance they hold that dividend. But I figured the board's got a formal dividend policy that we should run with, even if the board's actually choosing to ignore it. So I guess it's going to be an interesting reporting season there to see what happens there. The other key data point is Telstra have said they need to have at least $7.5 billion of underlying EBITDA in order to hold the dividend. Right now we're at about 6.5, maybe 6.8 billion of underlying EBITDA. So they've basically got to add close to $1 billion of recurring or underlying earnings in order to hold that dividend. More interestingly, though, for Telstra is the catalyst. So said for a long time now, the sum of the parts is worth substantially more than the whole. The problem has been Telstra's willingness to actually crystallise that and create value. In August, they said we're not going down this path, and then a couple of months later in November, they said we are going down this path. So this February, they've committed to giving us an update on monetising their infrastructure mobile towers business. And if they go down that path and do that, there is the potential from that alone to add 10 or 20 cents of value. If you just look at mobile tower comps globally, there's always the fine print to look at, but just high level, that's kind of what it looks like. So there's definitely the potential for value creation here. I don't think it's being priced in at all, so it does look like an asymmetric bet. The other kind of two key things to bear in mind for Telstra are the 5G rollout. With iPhones, obviously they were released, the 5G ones, just before Christmas, so you might actually see a healthy kick in mobile subscribers for Telstra. And now that we're Again, 95% of the way through the NBN rollout, they're starting to talk about the potential for fixed wireless bypass using 5G, and that has some meaningful potential, I think, as well. Next stock, which is actually our preferred pick in the telco space, in the fixed line style, fixed to mobile, is TPG. They're reporting on the 25th. This is really the first time we're going to hear from management after having their feet really under the desk. They spoke in August, but they just merged in July, so we really got nothing meaningful out of them. We know that earnings, or we assume that earnings are going to decline as a result of the NBN and COVID. So that's kind of the key thing to be conscious of, and we are not expecting a dividend. But what we are expecting is that the modus operandus from TPG will be the same as it has pre the merged entity. So if you look at the group now, 3 of the 4 key executives are ex-TPG people, so we think they'll operate it like TPG. The one exception is Anaki, who's the CEO of the group. The chairman, the CFO, and the legal counsel have all been with David Teo for a long time. So we think this stock will continue to be continue to deliver how it traditionally has, which is with limited forward-looking disclosure in detail, but really, really good execution. So that's the key reason that TPG is our key pick. The second key pick in the telco sector is NextDC. Reporting date to be confirmed, but late February. We are expecting a strong result, but that guidance will be held. M2 and S2 should be do the heavy lifting for this stock. But the key thing really in terms of the outlook is these options. About 12 months ago, NextDC effectively granted some of the big cloud service providers 57 megawatts of options. It took them 10 years to do 70 megawatts of sales. So it's a huge amount of options on the table. If they get exercised, they will add probably $100 million of EBITDA to the earnings in the business. And clearly, I think they'll give the share price a kick along. So what's going to make them get exercised? Well, the cloud service providers need to see continued strong demand in order to need data centers like NextDC to meet that demand. We saw the quarterlies come out from Amazon, Microsoft, Google in the last couple of weeks, and they've all been very strong. They've met or beat at the actuals and beat generally on the outlook. So we're looking at 30, 40, 50% year-on-year growth there. So we've got some really strong growth coming out of those cloud providers. I think there's a high likelihood they'll exercise their options with NextDC. And then Perth is also a bit of a surprise candidate in Asia. Singapore and Hong Kong are basically closed for business with respect to data center builds. So Perth is actually a candidate with 2 shiny new submarine cables there. And then just other stocks of interest. We did recently upgrade Technology One, T&E, to an ad. It doesn't report this season, but we will get their AGM commentary. So that's a good one. And AI Media, a little small cap company that I think's done an exceptional job. They've always met or beat expectations, but it is underwater post IPO. I think it just got caught up in the huge amount of IPOs and basically became a funding source. On the fence, we've got Superloop. Look, we do think there's still huge unrealised value here, but we think you really need to wait for the August result to see sales traction from the additional sales people that joined now about 6 months ago. It normally takes closer to 12 months to get traction. So that's a value play. We think there's potential there. Just mentioning First Wave, which has performed incredibly well over the last 12 months. It's been a rocky ride, but we did just recently move it back to a hold. So that's one we're happy holding. And then potential funding sources. NextDC, not NextDC, Megaport. We've got that on a hold. We still really like it long term, but in the short term, we don't think it'll go anywhere. We think they've got to sort of engineer the business a little bit to crack the 100 mil recurring revenue line, which we think they'll do this year, but not an easy task. So I think it's sort of range bound, as is probably Over the Wire and Dubber. So I might just leave it there with 3 key points on my key picks. So NextDC, number 1, it's a tech company with significant growth and significant cash flow. 2, it's got huge structural growth. And 3, it's got a very strong balance sheet, recently completed over $1 billion of funding. So it's well funded to continue to grow. TPG, the NBN is 95% built and 90% of the earnings hit has occurred by June of this year. They're on the attack on the mobile side, not the back foot defending, but attacking with substantial mobile spectrum. And number 3, management. Management do own over $1 billion worth of stock, so significant skin in the game and a very strong track record of exceptional outperformance. And then finally, AI Media, we think they've met or beat all the targets that have been put out there. There is really strong structural growth, and again, management own a huge chunk of this stock.